If you only think of agency revenue as commissions, you're seeing about half the picture. The agencies that scale, sell well, and survive market shifts have built 4 to 5 distinct revenue streams that compound on top of each other. This training is about how that stack actually works and which streams to prioritize as the agency grows. Most newer agency owners think the path to higher revenue is simple. Write more applications, collect more commissions, repeat. The truth is that producer-level commission income hits a ceiling. There are only so many hours in a week, only so many appointments a producer can run, and only so much an owner can personally write before the math caps out. The agencies that break through that ceiling do it by stacking revenue streams. Commissions are the foundation. But on top of commissions sit overrides, renewals, profit sharing, growth bonuses, and in many cases, broker fees or service revenue. Each stream is paid for different work. Each stream has different volatility. Together, they turn a transactional business into something closer to a recurring revenue operation. Why this matters? Because the agency owner who understands the full stack makes different decisions about who to hire, what carriers to contract with, what percentage of business to write where, and what the agency is actually worth. The agency owner who only understands commissions runs a glorified sales job. The agency owner who understands overrides and contingencies runs an asset. There's also a personal dimension. The right revenue mix is what allows agency owners to step out of daily production. A book that pays only commissions requires constant new sales. A book layered with overrides, renewals, and bonuses can produce meaningful income, even in months where the owner barely sees a client. Let's walk the stack. There are 6 revenue streams every agency owner should understand and ideally develop. Stream 1, new business commissions. The most familiar one, a percentage of first-year premium paid by the carrier when an application is submitted and approved. New business commissions are the gas pedal of the agency. They fund growth, lead spend, and producer compensation. They're also the most volatile because they depend on consistent production every single month. Stream 2, renewal commissions, the most underrated revenue stream in the industry. Many policies pay a renewal commission, sometimes for the life of the policy. Medicare Advantage pays roughly half of first year for years 2 through 6 in most cases. Life insurance often pays renewals for 10 years or more on certain product lines. Property and casualty pays renewals as long as the policy stays on the books. Renewals are quiet, recurring, and over time become the largest single line of agency income. Stream 3, overrides. Overrides are additional compensation paid to agency owners and agencies that meet certain volume, structure, or hierarchy thresholds. They come in several forms. The carrier may pay an override directly to the agency on every policy written, regardless of which producer wrote it. An upline organization may pay an override based on aggregated production across the agency. In some cases, an override is paid for placing business with a particular carrier or for hitting volume tiers. Overrides are usually small as a percentage, but they apply across the entire book, which makes them meaningful at scale. Stream 4, profit sharing and contingency bonuses. These are the most volatile and the most lucrative when they hit. Carriers pay profit sharing or contingency bonuses based on the loss ratio and growth performance of the agency's book with that carrier. The math is simple. If your clients with that carrier pay more in premium than they cost in claims, the carrier shares part of the profit with you. Profit sharing typically runs 1 to 2% of total written premium, which on a $5 million book is $50,000 to $100,000 in a year. Profit sharing is unpredictable. A few large claims can wipe a year out. A clean year on a growing book can deliver a check that funds an entire quarter. Agency owners who learn to manage their book with loss ratio in mind start to treat profit sharing as a real revenue stream rather than a surprise. Stream 5, growth and retention bonuses. Some carriers pay structured bonuses for hitting growth targets, retention thresholds, or specific product mix. These are announced at the start of the year and paid quarterly or annually. Smart owners build production targets directly off the bonus structures of their top 3 or 4 carriers. Stream 6, service fees and ancillary revenue. Some agencies generate additional revenue through advisory or service fees, financial planning subscriptions, or fee-based consulting on commercial accounts. This stream isn't right for every agency, but where it fits, it adds a layer of recurring revenue that doesn't depend on carrier compensation at all. Here's the strategic question. Which streams should you focus on at each stage of agency growth? Stage 1, solo or two-producer agency. Focus is almost entirely on new business commissions and renewal commissions. You're building the book. Overrides at this stage are limited because volume isn't there yet, and profit sharing is small dollars on a small book. The work is volume of quality production plus retention, so renewals start compounding. Stage 2, 5 to 10 producer agency. Overrides become meaningful. Carrier contracts get richer because volume is there. Profit sharing starts to matter. The agency should renegotiate carrier contracts annually at this stage to capture better override structures. Many owners leave significant money on the table because they never ask. Stage 3, mature multi-line agency. The full stack is active. Renewals are a large recurring base. Overrides on every line. Profit sharing is a real revenue stream the agency plans around. Growth bonuses are built into producer comp structures. The agency starts to look like a financial asset rather than a sales operation. Let's walk through what this looks like in practice. Robert owns a Medicare and life agency that grew from solo to 7 producers over 6 years. In year 1, 95% of revenue came from new business commissions. By year 3, renewals had grown to about 30% of total revenue, and a small override on the upline contract was adding another 5%. Year 4 was when Robert renegotiated. He'd built enough volume to qualify for better override structures with 2 top carriers. The new contracts added roughly 7% on every Medicare Advantage policy and a base override on his life production. Same book, more revenue per policy. Year 5, he hit profit sharing for the first time. Loss ratio on his health book was strong, and the carrier paid a contingency bonus of about $40,000 on a single check. He started managing the book with loss ratio in mind, which meant being more careful about the prospects he wrote and more diligent about retention. By year 6, the revenue mix looked completely different. New business commissions were 45% of revenue, renewals were 35%, overrides were 10%, profit sharing and growth bonuses combined another 10%. The agency could survive a slow new business month because the recurring revenue was carrying the lights. That stability is what changed the business. A few common mistakes to avoid. The first is signing the first carrier contract that's offered without understanding the override structure. Carrier contracts vary widely. 2 agencies with the same volume can earn different revenue depending on what was negotiated up front. The second is ignoring renewals. Most owners track new business obsessively and never look at the renewal report. Renewals are the asset. Track them every month. The third is failing to manage loss ratio. The clients you write affect what profit sharing you collect for years afterward. Quality of book matters as much as quantity. The fourth is leaving overrides on the table by failing to renegotiate. Carrier and upline contracts should be reviewed annually. Production grows, and the contract terms should grow with it. Here's your action step. This week, do 3 things. Pull a revenue breakdown for the last 12 months. Separate new business commissions, renewal commissions, overrides, and any bonuses. Most agencies have never run this report and are surprised by the result. Next, review your top 3 carrier contracts. Write down the override structure on each. If you don't know it cold, request a copy. And third, calendar an annual contract review for every carrier and upline relationship, 60 days before the anniversary, every year. Revenue is what builds the agency. The streams that compound are what build the asset. Understand the stack, manage every layer of it, and the agency turns into something far more valuable than a sales operation.